when there's a flight to safety in the market, you have an increase in the amount of bond buyers. So that bond buyers will lower the 10-year yield, and that means mortgage rates will usually come down with that.
Hey, this is Betsy Stubblefield, Weichert Realtors Big Dog Group. I'm here with John Phillips from FirstBank. John, tell us a little bit about you.
Well, I grew up in Northwest Alabama and found myself here in Middle Tennessee back in 2007. Been working in the Fairview area for about that length of time, and yeah.
Cool.
Yeah, great.
How'd you get with FirstBank?
Well, I relocated here from Birmingham in 2007, and was working with a company for I've been working with them since 2005. That's when I got into the mortgage business. You know, that's when 2008 came, and
Right.
which was really bad times for the real estate industry, the mortgage industry in particular. And you know, I was just I needed to find another company to go to, and looked around and looked for a company that fit my culture, and FirstBank was it.
Cool.
And at that time, there were 13 mortgage folks in the mortgage department at FirstBank, and this was 2009. And of course, now that number has grown into the hundreds. So we've seen quite a bit of growth over the years at FirstBank.
Yeah, definitely. Well, we like having you as a partner in one of our teams.
Well, I like having you guys too.
Yeah.
You guys are awesome.
Well, thank you. So let's get into kind of the market and where we're sitting today, because a lot of people fear 2008 happening over again, especially with the rates going up. Kind of where do you see us in the market today?
Well, it's a lot of folks think we're heading to 2008, and if you lived through 2008 in the real estate world, or lived in it, period, they were bad times. But this is not 2008. There's a lot of big differences right now. First of all, the mortgages that have been done, you know, since 2009 have all been fully documented, and the default levels right now are at an all-time low. One of the biggest differences between now and 2008 is supply versus demand. So a lot of people don't realize that back in 2008, there was no demand, and you had a glut of homes, and you know that's why the market fell so drastically. That on top of, you know, all the bad loans that were done. There were a lot of bad loans done. It was the perfect storm. Just a lot of nonsense that went on in the mortgage industry, and luckily a lot of those folks have exited the industry and are no longer with us, and we've been doing fully documented loans. The demand now is so much greater versus the amount of supply. Right now in the market, you know, we have about 1.6 million homes that are for sale in the United States right now. A lot of people don't realize that. That's very low for inventory. Of course, that number is growing with the increase in rates that we've had. So a lot of people have asked, like, John, so why was the demand different? Well, you have to look at the median age for a first-time home buyer that's 33 years old. All right, and if we subtract 33 years from 2007, 2008, that was the last Great Recession, you know, birth rates were extremely low. Okay, we subtract 33 years from today, birth rates were extremely high. So demand is very, very high.
So in 2007, there was a lot of people that were kind of upside down in their mortgages, being that they didn't have a lot of equity. Where are we at today?
That's right. Good question. 2007, we had about $12 trillion worth of equity in homes. So that means that, you know, if you take their value, subtract out their loan, that would be their equity. So we had about $12 trillion in equity in 2007. Today we have about $28 trillion in equity.
Wow.
So there's a big difference there.
Yeah.
And that's another reason that, you know, this slowdown that we will go into, you know, it's not going to affect housing. It's not going to affect housing at all, because we have the demand, we have the equity. 2008 was much different. If you go back and look over the last 8 recessions that we've had in this country, only one recession is where we had a housing downturn.
Yeah.
One interesting thing that people have brought up to me is mortgage rates. Like where are we going with mortgage rates with this? And with the Fed, they started out this year at 25 basis point increase in the Fed funds rate. The Fed funds rate is the rate that banks lend to other banks. And then the prime rate may follow. So when they raise the Fed funds rate, that affects consumer credit, car loans, credit cards, boats, ATV loans, businesses loaning money for their business. And a lot of people think that, okay, well, the Fed funds rate is tied to the mortgage rate. It's not. It's not. I have this conversation daily. Mortgage rates are not tied. They go in correlation with the 10-year yield, mortgage-backed securities. So when there's a flight to safety in the market, you have an increase in the amount of bond buyers. So that bond buyers will lower the 10-year yield, and that means mortgage rates will usually come down with that. So when people are buying a lot of equities, that would be stocks, you could see mortgage rates reverse. I can tell you one thing that MBSs, that's mortgage-backed securities, do not like is inflation. And of course, the CPI, the latest CPI report, was 8.6%. So you've had a big mass exodus of mortgage-backed securities, and that's what's brought the 30-year fixed rate, and we've seen it as high as 6.25%, and we are now seeing it drop. So we've got the latest PCE report out, and PCE report is an inflation report as well. The PCE report is the one that the Fed likes to look at the most, and we saw that inflation report go up. However, inflation is cooling. So we think that now, and we're doing this podcast in June of 2022, we think inflation has peaked, and the Fed should think that too. The Fed will still increase the Fed funds rate by 75 basis points. But guess what? That's going to actually bring mortgage rates even lower, because they always kind of have a reversal effect. So actually, we see mortgage rates in the latter part of this year going back down into the high 4s, low 5s. And in fact, my prediction for the end of the year is 3.875 on average 30-year fix.
Wow.
And the consumers out there need to hear this, because we are going to lower rates. Now, we're not going to see the interest rates that we saw during COVID years of 2020 and 2021, but we will get some cooling. And we may go into a recession, but I don't want people to fear that it's going to be like 2008. It will not be as bad as it was. Real estate prices will hold. And, if you go on social media, you see all this fear mongering going on. Real estate prices will hold. We've been sitting around, on average, 20%, 20+% year over year with appreciation. That's probably going to back off, maybe half, going into 2023. But that means appreciation is still going to grow at least 10%. In fact, the last Case-Shiller, you probably look at Case-Shiller report, that monitors real estate appreciation. Right now, for this year, it's 2.1% month over month and 20.4% year over year.
That really means that even though it's not necessarily, people are scared that it's all of a sudden not a seller's market, because the absorption rate, which is the rate at which all the homes on the market currently would be gone off the market, people are afraid that it's all of a sudden not a seller's market, so it's not a good time to sell. And really, that's not true. The absorption rate around this area is about 2%, about 2 months right now. And all that really means is it's still very much a seller's market. It's just they're not, we're not at like 2 days to about 2 weeks.
Yes, I think we got spoiled.
Yeah.
Really everyone got spoiled and like, oh well, my home didn't sell in half a day.
Yeah.
It was amazing that I saw the local MLS reports go from 1 day on the market to half a day.
Yeah.
I've never seen that before.
Yeah, me neither.
We're going back, right. We're going to 30 days on
Yeah.
average right now. That seems to be what's going on, and that's a good rate. I think I tell people right now, it's time to buy, because you do have sellers that are spooked a little bit, and they're probably willing to wiggle on the price a little bit.
Yeah.
But like I said, there's only 1.6 million homes on the market in the entire United States. There's 12 million families that need a home right now.
Yeah.
If that tells you anything, it's demand. The demand is there.
It feels like 6 million of that 12 million is coming to Middle Tennessee.
Yeah, they're all coming. Yeah, and Middle Tennessee, everything's going to be fine because
Yeah.
there's a lot of folks that are flocking here.
Yeah, yeah.
And it's, I would, if I were a buyer right now, or if I was someone wanting to get pre-approved right now, I would do it now.
Mm-hmm.
And here's why. You want to get that out of the way, of course, be pre-approved, be ready to go. But you can go out and probably, make some offers. When before you were kind of, thinking, well, I've got to offer more.
Right.
You could go out and make some legitimate offers to a seller. And if they don't like it, well, you know what? I believe you're going to see more inventory.
Yeah.
Because there are a lot of sellers that are getting a little spooked thinking that, well, appreciation is going to turn into depreciation.
Right.
That's simply not going to happen. Not going to happen. But I think inventory will increase, even though mortgage rates will decrease slightly and kind of normalize as we get inflation numbers down. As inflation drops, mortgage rates will drop.
Yeah.
Energy prices
Yeah.
in that bucket as well.
Right. So on talking about equity, if somebody has a bunch of equity in their home, they got their home appraised, and say they've got like 50% of the value of their home as equity. What are some of the ways that they can use their equity to maybe buy another home or to maybe fix up their home, or how all does that work?
Robert Kiyosaki, I'm a big fan of, and if you haven't read his book,
Rich Dad, Poor Dad,
you need to watch it, and read it, or if you're like me, I do audiobooks, so listen to it. But he talks about if you pulling equity, how money is created is pulling money out of your house, equity out of your house, and you don't pay tax on that at all. And he goes on and says, why didn't you think you pay tax on that? And I don't know, because it's created. That's how money's created. So you can take that money and then buy another asset, and then you can go and be doing this and not paying any taxes. So the key is to get someone to rent out that home, pay down your debt, get some cash flow, which would be tax free on the money you put into the home. And then that home will appreciate. And as we talked about before, it may not be the latest Case-Shiller of 20.4% year over year, but it may be 10%. And I think that's a better investment that you're going to get anywhere in the equities market right now. We do that, as far as cashing out, we can do that on a primary home, up to 80% loan to value. And then, when you start building these investments, we can take cash out of an investment home at 75% loan to value. So meaning if you don't owe anything on an investment property, and I'm just using this as an example, there's most people that owe something, right? Because it's not bad debt, it's good debt. But let's just say you owe nothing on it. I could give you, if it was worth $100,000, I could give you $75,000 cash. You take that money, you buy another property. And then you just keep doing that. And that's really a good wealth building tool. It's the best.
And really, that's how people move up in getting a home that's priced higher.
That's right.
That's got a higher value. You start out slow, and this is something that I've even explained to even like my nephews who are kind of in that 20-year range where they're 20-year-olds where they're trying to get into their first home. It's like, you have to take the first home and you build up some equity in it, because the value's appreciating. You're paying down your mortgage, right? What you owe. So now this pocket in there is equity, and you use that to put down payment on the next home. You build up some more equity, and you put that down on the next home. And before you know it, you can afford, instead of a $200,000 home, dollar home, you can afford a $500,000
That's right. And a lot of people say, well, my debt to income, it won't allow. Well, Fannie Mae has came out in the last few years, and they said, well, you got your primary home, you want to buy another home. On your primary home, let's turn it into an investment home and go out there and get a renter, get the first month's deposit, get the first month's rent, and then we'll use 75% of the future rental income to offset the debt to income. That way you can go ahead and buy another home. So what they'll do is you need to live in the home at least a year, and then get a renter for that home after the full 12 months. Find another house, buy that house, then move into that house, and do the same thing over and over again. That's how a lot of folks are doing this, and they're adding to their portfolio
Right.
of rental properties.
Right.
If you're not into that, you can look at the cash out option I talked about, or just cashing it out of your primary home, or getting what's called a home equity line of credit, to where you can use that as a bridge or down payment for the next house.
Very cool.
Building a real estate portfolio is the way to go long term. Would you guess how many investors, if you look at all the homes in Middle Tennessee, you want to guess how many of the homes are owned by investors? Scary, but it's cool.
I'm gonna say probably 30%.
50%.
Wow.
50% of the homes in Middle Tennessee and across the U.S. are owned by investors.
Wow.
Yeah. And of course, there's been some bad
Yeah.
press out there with
Yeah.
investors buying up
Yeah.
properties and whatnot.
Right. But there's a lot of people who want to rent or need to rent.
Yeah, there's always going to be a
So,
need for that.
yeah.
But we hope one day to get you into a home.